Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. Learn more about our show at insightfulinvestor.org. I'm very excited to have Alan Waxman join the podcast today. Alan is co-founding partner and CEO of Sixth Street, which is a global investment firm managing over $100 billion in assets as of year-end. After rising to become one of Goldman Sachs' youngest ever partners, he co-launched Sixth Street in 2009, building a firm that's well known for its flexible, long-term capital, data-driven approach, and cross-platform collaboration. We're going to talk about all these things today. Alan, welcome to the Insightful Investor Podcast.
Alex, thanks for having me. It's good to be here.
Let's start with your background. Would you talk about where you got your start before founding Sixth Street?
Sure. I grew up in Austin, Texas, public school. This is Austin, Texas before it was Austin, Texas. When I grew up, it was a college town, Anderson High School, public high school. No one really left the state of Texas from my high school. I played soccer and basketball, and University of Texas didn't have a Division I soccer team, so that wasn't an option. And then University of Pennsylvania, had an interesting program from a soccer perspective. Obviously, academically was an interesting thing, and basically went to Penn as an international relations major. Wasn't thinking about finance at all. Was mostly thinking about at some point I wanted to be a lawyer. I took very few finance classes, and then about my senior year, all my friends basically we're thinking about finance. And at that time, that was back in 1997, everyone was thinking about investment banking. That was kind of like the thing to do. Because I was captain of the soccer team, I got a lot of interviews. I had like 35 interviews, interviewed with Goldman Sachs 4 different times, all the other banks, and basically came out of college without a job. I was the only one of my friends without a job. So I went 0 for 35, but I got a lot of experience interviewing. And then I ended up basically taking almost like an administrative role at a long bond manager called Fisher Francis Trees and Watch, which is a long bond only manager. And I was basically in the mailroom. So back then they'd make these pitch books and the analysts would work on them and I'd be in there punching books. And at some point I basically said, all my friends were going out, they were doing interesting things, looking at companies. And I said, listen, I got to figure out a way out of this. There's some really cool things. I was interested in companies. I took CFA level 1 and started trying to teach myself corporate finance, just like basic finance principles. And my entire life and why I'm here today changed on an airplane from Austin, Texas to New York via Houston, Texas, where I was sitting next to a guy on an airplane who was probably I've never seen a human being read as fast. They're like on the airplane. He's like going through research reports, like really fast. But I was fascinated because how quickly he's going through. So we started talking on the plane, and he had just started at Goldman Sachs, and this new group it's had a bunch of different names, but became the Special Situations Group. And we started talking, and he saw me studying for the CFA, and we started just getting to know each other. I played on his like basketball team in sort of like a community league. And he said, "Do you want to come in for an interview?" And at that time, Goldman Sachs was, it was the hardest job to get coming out of college. And I went in an interview. I knew enough, but I certainly wasn't as qualified as some of the other candidates. But they really liked the fact that I played college. Like one of my college games with a broken leg. That was like the story. They liked that, or broken ankle. They really liked that. And I basically over the last 150 years, if you were to pick the best group to come into at Goldman Sachs at the exact right time, that's the group I came into, which became the Special Situations Group, which was, basically the Navy SEAL. It ultimately became called the Navy SEAL Group at Goldman Sachs because of its profitability. And it was basically investing the firm's balance sheet. We didn't have outside investors, so there was no LPs. We had one LP. It was basically the CFO, David Vineyard, who's become one of my mentors in life. And what was unique about it, and this is kind of building up to Sixth Street, is that the whole alternative universe is set up by basically pensions and sovereign wealth funds. And now wealth, they have a private equity group. They have a private credit group. They have a real estate group. They have a infrastructure group. We didn't have any of that because we only had one investor. And our mandate was literally to figure out across all those asset classes, where's the best risk reward. And the whole philosophy was the world's always changing. There's credit cycles, there's economic cycles. Maybe the best opportunities in infrastructure today, but in 6 months, maybe the best opportunities in real estate, maybe it's private credit. So we were completely agnostic between asset classes. We were constantly comparing relative risk reward. And our only objective, literally our only constraint, was don't lose money. And that's kind of how we grew up as investors. And that's really sort of the background of like really the foundation of the idea of Sixth Street. And from that, I met 12 partners. So 12 of my partners at Sixth Street, we worked together at Goldman. And in 2009, we founded Sixth Street. But that's kind of how it all evolved.
A fascinating story. Well, you spent a decade at Goldman Sachs, and at age 31, you became one of their youngest partners in history. What would you say were the most important lessons you learned at Goldman about investing? You mentioned some already, and also leadership that you feel still guide you today.
What I learned at Goldman is because we were investing across so many different asset classes, the importance of culture. I ended up being the chief investment officer and running the group. Just to give you a sense, it's about a $25 billion of Goldman's balance sheet. So it's a big business. It's the largest principal investing business. We're a largest investing opportunistic investor at the time, really probably in the world at the time. Now it's changed because all these, big public guys, but back then, and really just the whole investment philosophy of constantly this whole idea that thematically, every theme has a shelf life. And something that's really good has a shelf life of 12 months to 36 months. And ultimately capital flows to it. And it gets a little bit less good, a little bit less good. Then it gets not good. And then it gets really not good. And then it basically sort of reverses itself and at some time gets good again. So we were constantly migrating to where the best risk reward is across themes and across asset classes. And then comparing sort of this asset class to this asset class, this investment, even like effectively what we would call like unitizing risk units and return units. And that style of investing was dependent on culture, because if you had a bunch of teams and sector teams that weren't talking to each other, you really wouldn't be able to sort of systematically compare relative risk reward between all these different asset classes. So that was the big kind of aha, the sort of the connection between multi-strategy capital investing, which is what we were doing, and culture. So that was kind of on the investing side.
And then really quickly on that. So that's more like building a portfolio from a top-down perspective rather than just managing a product.
We actually don't even use the word products at Sixth Street. We talk about strategies. And again, it goes back to this philosophy that the world's constantly changing, which is why Sixth Street's mandate, it's a very flexible mandate. And it's built on, again, this idea that look at the last 6 months. The world, there's credit cycles, there's economic cycles, there's secular cycles within companies. And and it changed. Attractiveness, because capital flows to the best opportunities, you have to constantly be comparing things across different, what we would call different windows. And that's kind of, that's what we do. So that's kind of like the underpinnings of our investment philosophy that we've really been investing over, 27 plus years. But that's on the investing side. That's kind of how we think about it. Just to get back on the leadership side, what I learned on the leadership side. So I basically started running businesses at Goldman when I was 24 years old. It was a lot of luck, but basically there was a bank called Amresco, which was a Texas-based bank, and they were basically failing, and they had this portfolio called RTV Ventures that was a portfolio of all these what are called now a bunch of direct loans. That wasn't what it was called back then, but it was basically these direct loans originated in the radio and TV space. And because the bank was going through a challenging time, they needed to sell assets. So me, as an international agent who didn't know anything, basically was deployed because back then, Goldman was incredibly entrepreneurial, and they gave a ton of responsibility to young people. We ended up buying that portfolio. And what I learned from that portfolio, and this sort of ties into leadership, is basically this whole idea that banks were really thinking about things in a very credit-like box. And there were sort of opportunities to maintain the same level of risk and low loss rates, but to do different things that the bank couldn't do. And therefore, you'd sort of construct better risk reward than what a bank could do. And that was kind of the idea of the direct lending business, which is the business plan that I wrote. I think I wrote that in 2000. It's the first time Goldman got into the middle market. And that's when I started running businesses. And what I learned from that, and I wasn't qualified, but there was a guy who ran MRS, who ran the RTV Ventures business named Stephen Plus, who's now Sixth Street's chief risk officer, he was really the person that was, even though I was technically his boss, he was kind of teaching me. It was like, that was the best training I would get. But what I learned from that experience in building out that business, it's all, again, it comes down to people and culture. And it's about having the right people in the right seats, making those people to work together and all climbing up the mountain together. And that's what I started to learn. And just, since then, I think I've been part of 21 different business builds from based our time at Goldman to our time at Sixth Street. And that was kind of the thing I learned. And the other thing I learned is, and this is something just watching, quite frankly, what not to do than watching people what to do, is just the whole idea of like, just no politics, no BS, just straight communication, on the table culture, and just a very direct communicator, even if it's uncomfortable. And that's kind of just because I think authenticity is so important from a leadership perspective. And I had bosses that were not that, or they would, be evasive or whatever. And it just watching what not to do really sort of drilled in, like just the whole idea of like authenticity as a leader. So I'd say there's many other lessons, but those are some of the ones.
So you were 0 for 35 right out of school. And in short order, and you even said maybe you weren't the most qualified, in short order, you rose rapidly. Are there personal qualities that you possess that you feel like contributed to that rapid rise?
I think there's a lot of luck. I got into the best group at the best. I was literally the first analyst they ever hired in that group. It was literally complete luck. I got lucky because I had great people around me to learn from, like Stephen Plus and the person I met on the airplane, Jody Lanassa. I learned a lot from him, one of the smartest humans in the world. There were other people around Goldman Sachs. So I think there's a lot of luck involved. What I tried to bring to the table was just a work ethic that was, because I always had a little bit of because I wasn't a finance person, I didn't go to Wharton. I was kind of like, came from a liberal arts background. I had a little bit of a chip on my shoulder. And, my whole thing was, I'm just going to outwork people. And, no one was going to outwork me. And that was kind of the beginning. That, by the way, in hindsight, that may not have been the right thing to think about. That was my mindset, because I have a little bit of chip on my shoulder. And the other thing, something my dad taught me, is I think oftentimes junior people come in and they're scared to put their ideas on the table. They're with three Goldman Sachs partners in your room. You have an idea, you have a viewpoint, but they're scared because they're scared how they're going to be perceived. And that's one thing my dad taught me, is just this whole idea of like human being to human beings. I never thought of anyone across the table as like, from the time I was a young age, like as a Goldman Sachs partner or MD or this. I just thought they were a human being. And if I had something to say and it was well researched and substantive, even though I probably said a lot of things that weren't smart, I put it on the table. And, I remember one time in an investment committee at a very young age, it was actually really uncomfortable, but my boss at the time, who ran the group, who ended up being sort of moved out of the firm because of some communication issues. We're an investment committee, and the two partners on the investment committee asked him what he thought about the deal. And he basically said something that just wasn't accurate about the diligence that we did. And then they asked me, and I said, that's just not accurate. That's not what it is. And that was kind of like the beginning of just kind of a little bit affirmation my dad always told me. And I just literally let it rip. I remember when I was presenting the business plan to direct lending it to Hank Paulson and Lloyd Blankfein, I go in this room, I'm like shaking. I have no like communication skills. I've never done, I'm literally shaking. I'm writing down, I'm presenting the business plan for what's now called direct lending. And, I just said, before I went in the meeting, I called my dad, and he's like, he used to always say this thing about facing the tiger. He's like, face the tiger. And I just went in there and I just did it, and it got approved, and, became a massive business at Goldman, and really sort of started to, launch my career at the time. So I just think this whole idea of, you have to be well researched, you have to be substantive, but don't be afraid to put your ideas on the table, was kind of something I just sort of internalized at a very young age. And I just let it rip. And it, that was kind of my idea at a young age.
And kind of studying your history and just the conversation we're having now, I wonder if this is also a part of it. So in my experience, many people struggle to articulate their thoughts. And I think that's often because their ideas aren't really fully clear to themselves. And I know you've emphasized the importance of independent thinking and asking very simple, clarifying questions and not being afraid of asking dumb questions. Do you feel like this approach is designed to help overcome that challenge?
100%. I think one of the problems with younger people as they go through their careers is a lot of groupthink. Your friends are talking about this, and it's easy to get caught up in a groupthink. And I at a very young age, I thought people were like smarter than me because everyone sounds so smart. What you find later in your career that a lot of people aren't. When you dig a little bit deeper, there's smart on the surface, but as you go drill down deeper, there's not always substance there. So my whole thing was I wasn't going to talk to any of our competitors. I'm not going to get caught up in the group think. Like even if I had friends that were in the business, I'd never talk to them about the business. So I can just keep my mind clear. And I think as part of that, one of the best way, if you sort of take out groupthink and you're not getting from your ideas, then it's all about curiosity. And I would literally, I still get all my friends and my wife makes fun of me all the time. Like I ask more questions than anyone. It's just part of who I am. In fact, there's dinners I've gone to where literally I'll literally ask every single question. They won't ask me one question about myself, and I'm totally fine with it. And that's kind of what it is. And I think going back to your question, like, I think once you sort of strip out the noise of everyone else and you start trying to do your own kind of independent thinking, by the way, comparing with the people on your team, obviously the whole idea of, what we call playing tennis with each other, like you want to have that like on your team, but not from sort of the outside world. Then you got to fill in the gaps on sort of upside, downside, watching your flanks, looking around corners, and that's all about asking questions. And I think it's just a great tool to learn. I think it's one of the most important things when people talk about what makes a good investor. It's like the ability to not only ask questions, but actively listen and kind of see everything. And I think that's a real skill. That's something we try to teach at Sixth Street.
The way I think about it is you're seeking whatever the truth is. And oftentimes it's not what everybody else thinks the truth is. So maybe you start there, or you even approach it from your own starting point. And then maybe at some point you can compare it to, this is my conclusion based on my observations. This is what everybody else thinks. Rather than starting with what everybody else thinks as your starting point, you kind of approach it independently.
Yeah, 100%. Our mission at Sixth Street is to deliver, outstanding outcomes for our capital partners, so our LPs. And if you're taking group think, it's very hard to deliver differentiated outcomes, both from a return perspective and from a loss rate perspective. So if you start with that premise, otherwise you're basically beta. And that's not what Sixth Street, again, other people have that model. That's not what we're doing. We're an investor first firm. So I think it's just a good discipline. And like you said, I think it's, look, ultimately the truth, we're truth seeking. We're like a heat seeking missile for the truth, wherever that leads us to. And you get there through your own independent thinking of ideas, but also, again, this whole idea within your team playing tennis with each other and constantly just sharing ideas and batting around. And we always say at Sixth Street, the best ideas that we've had in our firm, the most creative ideas we've had, the best deals we've done have come where there's two people with very strong opinions from both independent research. They play tennis with each other. They're kind of playing back and forth. And the best idea isn't either one of their ideas, it's something they thought of by playing tennis together. That's the best idea. Some of our best ideas have come from that. So again, but it all starts with sort of staying away from group think and trying to be an independent thinker. Otherwise, you're just resigning yourself to beta.
But to have that drive to seek whatever the truth is, it's an extra gear you have to have in your arsenal, because just in my experience talking to thousands of managers is that it's so easy to just do what everybody else does and try to do a little bit better, because you can make a lot of money by doing that and being good at marketing and telling a story, and most investors are not discerning enough to be able to tell the difference. So but you have to have that within you to strive to do better, for that to work.
Yeah, for us, 100% agree. And for us, it's got to be part of your culture. That's part of literally our genetic code from day one as an investor first firm, and it's got to be not only it's got to be in your culture. So it's in your review system. It's in the way you sort of compensate people. It's when you're recruiting people, looking for those characteristics of those people. The other thing I'd say is like, in order to be not have to talk about yourself and be truth seeking, you also have to, be humble. Because if you're not humble or you have an ego, you feel like you have to like talk or show people you're smart. And when we're interviewing people, we're constantly looking for people that, what we say, and we used to say humble or no ego, but one of our portfolio companies, the San Antonio Spurs, Greg Popovich and R.C. Buford, the Greg Popovich is the coach for the San Antonio Spurs, R.C. Buford's the CEO of the San Antonio Spurs. They have a test they do. Same thing is, they have a test for everyone they interview is like, are you over yourself yet? Because if you're over yourself yet, that's sort of the best sort of defining characteristic of what sets up to be a great teammate. I think for us, like that's got to be sort of a non-negotiable part of our values. And that's how we think about it. And again, they're not values in an abstract or cultures in an abstract. It's with the purpose of delivering great outcomes for your investors. Again, that's embedded in our culture, how we think about things.
So you launched the firm about 16 years ago. How has the vision evolved over that time frame?
Let's break it down in terms of multi-strategy private capital firm, which is what we wanted to be from day one, because that's the business we came from at Goldman. We built and came from at Goldman. Same thing. The difference is when we started day one, we just had an idea. We had a business plan. Today, we have 10 investment platforms. So that idea of sort of more capabilities, more investment platforms, we don't call them products, we call them strategies, but or call them investment platforms. Like that idea is the same. We just had to execute. It took us 16 years to get there. Investment philosophy, this whole idea we were talking about, 50 to 60 themes. We narrow it down to 15, 25 themes. We're constantly migrating those themes to find the best relative risk reward across all these different asset classes, sectors. Like that whole idea, that investment philosophy, it's the exact same investment philosophy that's in our business plan. And the third thing is like people. And the good thing is for us, we've got, because now we've been at this 16 years, we've got a team, not only the people that came from day one, so the other sort of 12 partners that I worked with at Goldman that are now at Sixth Street that are in leadership positions. But below that, we've now got multiple generations of talent that sort of grew up in this culture of an investor first culture. And this whole idea, no ego, no politics, no BS, no fiefdoms, no silos, sharing information, sharing relationships, all sort of in the mission to deliver great outcomes for our investors. And that's all those things are true from day one. I think what's different is, and I'm sure we'll talk about this, is the market structure of the alternative industry has evolved a lot. So that's changed quite a bit. But in terms of what we set out to do, like it's just really been about executing our plan to really sort of get back to where we were, what we built at Goldman, but do it here, but obviously do it outside the confines of a commercial bank.
And there's no way to really envision what the opportunities would be today, 16 years ago. So you have to remain flexible in your approach.
Again, going back to it, the premise of everything's always changing all the time within sectors. I mean, just think about the last 6 months. Think about the last 4 years. You can go through, and by the way, the next 5 years with AI and how that's going to change sort of the market structures and sectors and job markets. I mean, it's always changing. And that's why, again, when people raise these pointed strategies or these funds, if it's a 4-year investment period, maybe in 2 years, it's a great time that's the right call. But then you got the other 2 years when all the capital flow to it and it's less good. So that's what our kind of model's designed to do, is to constantly be aware, be flexible. But again, that skill set that we've been using since it's literally what we grew up doing is constantly comparing a US direct lending deal to a structured equity deal in Europe, to buying a credit card portfolio in Japan, to just constantly comparing like heterogeneous assets, but unitizing it, risk units or return units. In Sixth Street, although we're investing across 16 sector franchises, 10 investment platforms all over the world, every Sixth Street deal is a set of characteristics that have been the same characteristics that we've had since 27 plus years.
Are there any investment themes that you're focused on that you'd like to highlight?
So I'll give you a couple mega themes and then sort of some bottoms up sector themes. One big mega theme is, look, from 2019 to 2022, there was a bunch of levered private equity assets, whether that's not to say bad leverage, but just deals that got done in corporate private equity, real estate private equity, infrastructure private equity, that valuations were very different. Interest rate environment very different. So capital structures were built very different. And a lot of those companies, it's a large stock of companies, they need solutions. So that is what we try to do. And Alex, I think you know us pretty well, but we're constantly sort of, those solutions can vary by company, but we're trying to work with those companies. And there's a large amount of companies to work with to find win-win solutions that sort of solve what they're trying to do, whether it's get money back to LPs or sort of do a major acquisition. But I would say that is a real theme sort of really across asset classes. Another one, asset-based finance. Again, this whole idea, there's more and more stuff happening sort of outside the commercial banks, asset-based finance, very similar to direct lending, but a lot bigger than direct lending and a lot higher barriers to entries. That's a big theme. Again, everyone likes to do it differently. The way we like to do it is there's a lot of different heterogeneous components of asset-based finance, and we don't want to do one or two. We're constantly just looking across all of them to figure out at this point in time, is it consumer? Is it resi? Is it commercial? Is it some type of equipment finance? We're constantly looking across the ecosystem about sort of where the best relative risk reward is. But that's a big theme. And the other one, which has gotten a lot of attention and probably too overhyped right now, is just the whole sports and live entertainment. Why is it interesting? Look, as more people get into their phones, they value experiences more. We saw that during COVID, but you think about what's happened in AI, and unfortunately, a challenge with a lot of the younger generations where they're in their phones, they value experiences more. So they're looking for more and more experiences. And you've seen that sort of reflected in the valuations. For us, we try to approach it as a strategic. We're partnered with some of the biggest sports brands in the world. So it's like Real Madrid, Barcelona, Dallas Cowboys, New York Yankees, San Francisco Giants, San Antonio Spurs. And that creates a network effect that allows us to sort of just, although there might be maybe too much hype right now in sports, allows us to see, BFC, our women's soccer team, also to be able to see things in a different way. I mean, most of the things we look at in our sports and live entertainment, people are coming to us because they want us as their partner. They're not running big processes. And that's sort of the way we like to do it in sports. So those are three of the areas. But really, it's an interesting time right now. And I expect there to be a lot more activity because a lot of built up commerce or transaction volumes have been depressed for the last really 2 years. And assuming there's no more surprises, like it feels like there's going to be a lot of activity coming towards the back half of this year.
So you obviously operate across a wide range of asset classes, but how do you maintain excellence and focus across such a broad investment platform without diluting your edge?
First of all, it's because what we've done our entire careers. This is all we've done is, most of the firms that have the big public firms, they were born or birthed as a private equity firm, or they were born as, a very specific asset class. Because we were the way we grew up at Goldman Sachs, because we didn't have outside LPs, we could literally do anything as long as we didn't lose money. Like we just grew up as investors. We weren't private credit or private equity or real estate so we're just investors, but looking across all the asset classes. So I think the first thing is like, this is what we've done literally since this is all we've known as investors, that flexible comparing relative risk reward as economic and credit cycles and within secular trends happen. So I think that's the first thing. The second thing is culture is an investor first culture. Like that's embedded in everything we do. We just did our 5-year strategic plan. It's literally the centerpiece of our 5-year strategic plan is an investor first model. We can talk about what's happening in the industry, but it's got to be in the bloodstream. And then the third thing is like any business is something, going back to when I started running businesses at Goldman, is you got to have the right people in the right seats. You got to have the right people in the right seats and they're talking to each other. They feel as one team and you got to be marching up the mountain together. And right now, all the people in all those seats are people we've worked with, or I've worked with between 10 and 25 years, buying to the culture, buying the investment philosophy. And most importantly for us, they're counterculture to have fiefdoms and silos. Like they have to talk to each other, compare notes, share relationships. And that's really what Sixth Street's all about.
Would you talk about your cross-platform capabilities, how they're unique and how your approach helps position you to potentially have that first mover advantage?
Yeah. So, look, Sixth Street, we see about 400 to 550 deals a month coming to Sixth Street. Like it's a machine. There's stuff coming in, and a lot of times there's deals come into the right sort of group where that's a team that would execute the deal. But a lot of times they come in, a deal that might be a growth equity deal comes into our direct lending business or comes into our infrastructure business for whatever reason. And a lot of firms, like when that happens, that deal dies or it's slow to get to the other groups. At Sixth Street, like that's built into our technology, it's built into our culture. That's like simultaneously, because when you talk to one person at Sixth Street, doesn't matter what team you're talking to, you're delivering the firm. And that's literally something I think we've set up from day one. I think a number of competitors who are really good competitors, but they've tried to reverse engineer that because they started as this type of firm or that type of firm, and then they bought a bunch of businesses or they built things over time just because they were started a lot before us. It's possible to reverse engineer it, but it's much easier to do it when literally from day one in your business plan, everything you've done, every person you've hired is deliberate and intentional for that specific culture. And that's how we've done. And then the last thing I'd say, and this is really, really related to culture, is just constantly talking about it all the time. We always say, like, you got to talk about culture till you're literally tired of talking about it. You can't talk about it enough, because even like that's like the one lesson we've learned, because you're constantly bringing new people, you're constantly developing the next generation of talent, and it's got to be in the bloodstream. Otherwise, cultures can be destroyed very quickly. And that's sort of how we do it. But ultimately, it starts with leadership and having the right people in the right seats.
So you talked about this notion of an investor first firm. Would you describe how that's different from what I've heard you refer to in the past as a factory model?
Yeah. So go back 10 years ago, every firm in alternatives, well, most firms in alternatives, the good ones, they were all investor first firms, period. Like investor first. And when I think of investor first, it's, a deal comes in, you sort of turn it over, you look at it, you're not thinking about your deployment pace. If it's a good deal, you're going to do it. But if it's not a good deal, there's no pressures to sort of do it. Like, and there's a time and you're constantly just turning it over. I think over the last 4 years, and there's nothing wrong with this, but increasingly a number of firms have decided that they want to be more deployment factories. And again, there's nothing wrong with this. It's just a different business model, but setting targets, we're trying to hit those targets. And our view about investing, I sat up in front of our investors in 2017 and 2019, and I said, listen, if you want a deployment firm, like just literally like we're going to invest with a certain pace, that's not us. Like we're investors. If you want that, there's other people you should do that, but that's just not who we are as investor first. And I think right now there's like a fork in the road. And I think some firms are choosing to sort of stay true to their original ethos of investor firm first. And I think others are sort of going more down the deployment factory. And again, there's nothing wrong with it. It's just a different business model. But for Sixth Street and what we're all about, we love investing. Like we love investing. Like for us, it's very clear. And like I said, it's sort of plastered all over our 5-year strategic plan. It's like investor first firm in the service of our clients, which are our capital partners, which are LPs. And that's sort of what it is. But again, the industry is going through rapid changes. There's lots of dynamics, some of which you understand really well, being in sort of the wealth ecosystem. But that's kind of how we think about an investor first firm.
I'm going to share the way I think about it and tell me if it makes sense to you. I think of it as there's a spectrum. On one end, there are managers in the business of generating returns for their clients. That's their pure focus. On the other end, at the other end of the extreme, there are managers who are purely in the business of gathering assets and growing their revenues. And most firms are somewhere along that spectrum. And I think of investor first being more on the side of we want to do what's best for clients always. And then the other firms that maybe are more product oriented, I know you don't use the term product, but many do, and are kind of have standardized mass production systems in place are probably more on the, growing assets under management.
And by the way, there's nothing wrong with that because when you run a deployment factory, it allows you to offer things at the cheapest cost. So if you're an LP and your only consideration is literally the cheapest cost, it's easier to get the cheapest cost from a deployment factory because it's a factory. Like they're designed to, deployment at scale, and you can do things on a cheaper basis. But that's not what we're all about.
How are you going to grow the next 5 to 10 years? What's the plan?
We think out more in terms of capabilities. Like, so for us, the capabilities, like we've got 10 investment platforms. Those are the 10 investment platforms we want to have. We have 16 sector franchises. We're probably going to add one more sector franchise. So we'd like to be at 17. So 17 sector franchises. We're definitely have been pretty forward thinking on the engineering side and sort of AI side. And I would expect us to continue to sort of deploy more capabilities across our entire platform, from the investment process to the non-investment process. Those are really sort of the key areas that we're focused on over the next 5 or 10 years.
Are there certain problems that Sixth Street can solve for investors that others may not be able to?
I think what we do, as well as anyone out there, is going back to the way we grew up, which is this whole idea of comparing relative value at different parts of economic and credit cycles, different sort of secular cycles within sector, sort of on a dynamic basis where the best relative risk reward is. And that's one of our funds. Tau is the largest. We don't have any wealth investors. We don't have a lot of small investors. They're the hardest to get investors in the world, but that's the largest opportunistic fund in the world, private capital vehicle in the world that can do everything across Sixth Street. So that's about a $30 billion vehicle. And the reason why we have that vehicle is because, it goes back to when we first raised our first fund at Sixth Street. And I said to people, and so did some of my other partners, if you don't think we can compare across all these different asset classes and all these different sectors, the best relative risk reward at that point in time in a cycle, today, 6 months from now, then you shouldn't invest with us. That's literally literally the first set of meetings we had. That's what we told people. So we've been doing this for a long time, and right now, particularly in the wealth space, but in general, I don't think anyone's got this scaled experience that we have. Some people might put it together and put different businesses together and offer products that look like that, but to do it sort of, and it's in your blood and it's in your culture. I think that's what we do that's different than everyone in the world. And it goes back to the way that we grew up because, again, we were the most scaled player in the market back in the late 90s, early 2000s, mid 2000s, before everyone got really big. And we were sort of doing this at scale, and we only had one investor. Had we grown up and we had, a bunch of LPs that said you had to have this mandate and this mandate and this mandate, we wouldn't have gotten that experience. But we grew up with that experience, and we were able to grow up with that experience, seeing 98, 2001, 2002, 2008, COVID. That's what sort of makes us a little bit different than I think what's out there. Again, I'm not saying better. People can be the judge of that, but no one can say that. I don't think anyone else can say that.
You alluded to this a little bit earlier, but you've made some notable investments in sports franchises, including the NBA, women's soccer, European football clubs. What's driving your conviction in this sector? You talked about it a little bit, but if you could dig in a little bit more, and how do you assess the risk reward when, at least on the surface, it appears valuations are so high?
This goes back to like themes. Like the way we got into sports it was a mega theme because during COVID, we said, listen, the world was falling apart. Like, what are the best franchises that are most impacted by COVID? So one was Airbnb, which we did the Airbnb deal during COVID, which was one of the best deals done during COVID with Airbnb, great company. And the other theme, we had a bunch of other themes, but one of those themes was sports, because obviously, these are very recession-proof assets. We were observing during COVID that, people were in their shelters and seeking out experiences and getting in trouble for, trying to go have experiences. So you're starting to see human nature at its core. But a lot of the rules in the leagues didn't allow us to invest in sports teams or sports leagues. And so this all of a sudden, like, how do we sort of get involved here? So we had a big white paper thinking about how we're going to do this. How do we do this where we don't look like a financial, we can look like a strategic. So we bought Legends, which is in the ecosystem of sports and live entertainment. They're one of the core parts of the sports and ecosystem. We're partnered with the Dallas Cowboys and New York Yankees. And then we started targeting leagues and teams. And the first deal we did was literally the San Antonio. So I grew up in Austin, Texas, as I said, and we had a thesis around San Antonio and Austin, sort of that corridor is a growing corridor. Is there, it's a mid-market team, but it could really start to become sort of a major market team when you combine Austin and San Antonio and everything south of that. So literally the NBA changed their rules to allow institutional investors. And, literally immediately, one of my colleagues, Austin Bowers, emailed the Spurs, and they happened to be, because every team at the time was looking. And that's sort of how we sort of got into Spurs. And from there, we just started to create sort of a network. If you look at the deals we've done, they're the best brands in the world. But this whole idea, and this is kind of it, is one, people are going to value experiences more, sports and live entertainment. You can see that in viewership. But this other idea that, these teams used to be local market teams, but now the global brands have the potential to be global brands. And you start thinking about it not from a local basis, but from really a consumer perspective globally. Think about streaming. Back in the day, you couldn't watch your favorite soccer team in Europe. Now you can literally be anywhere on your phone, watch it. And you could be in Australia watching the Dallas Cowboys, or in France and watching the San Antonio Spurs, and you're literally just walking around, you have it on your iPhone. So that opens up just a whole nother set of consumer engagement and all the associated opportunities with that. So that was kind of the big sort of idea. And then from there, is like anything in investing, once you you have a platform and you build a network, instead of you having to go try to get deals come to you because people want to partner with you. And that's literally, most of our deals have been just literally bilateral conversations. People want to come talk to us. And that's kind of how we're set up.
Also, I suppose if that space is open to institutional capital, there's a big advantage to being early in that cycle.
No question. But just stepping back, Alex, that's kind of what Sixth Street does. Is remember, we have tentacles we have, just under 300 investment professionals. We're in 16 different sectors, 10 different investment platforms. We all have relationships. We've also all done this for a long time. The amount of information coming in, we can get a pretty good mental model of kind of the world and where the world's going. And our job as investors, and again, this goes back to the question you asked, is the groupthink question, is we're not thinking about what the world is or was. We're thinking about what it could be. And that's kind of how we think about things. And that's sort of where theme development comes from. And it's top down, it's bottoms up. But again, it's something we've been doing for 27 plus years.
That kind of circles back to be independent thinking. Don't just follow the herd, and build the culture of people that are oriented that way, and also build a flexible platform so you can take advantage of potential opportunities.
Yeah. And this is Sixth Street. This is kind of who we are. You look at wealth. We have 10 investment platforms. We're not putting a whole bunch of strategies on the shelves. We hired a head of wealth, I think 2 years ago. And we haven't really done anything because we like to watch, we like to be methodical so we can do it right and do it our way and not just try to follow what everyone else is doing. That's not the way our mental model works. That's not the way our culture works. Our culture, we have a bunch of aspects to our culture. One of them is what we talked about earlier, or facing the tiger. So facing the tiger with uncertainty, which is for us is when problems happen, that's what destroys culture. So when that happens, instead of pointing fingers or running from problems, we run from things together. But the other thing, we have 4 or 5 components to culture, but the other one is entrepreneurs. And an entrepreneur is not thinking about what everyone else is doing. We're trying to think about, how we're going to do it our way that's comfortable for us. And that's really just how we approach theme development. It's how we approach business building. It's how we approach investing. And it's just sort of in our bloodstream.
You just brought up the wealth management market. How would you describe kind of how you're thinking about it right now?
We've been on basically a 2-year listening tour, just listening and really trying to listen to what the end clients want, what the financial advisors, and can we do something in a way that solves solutions for them in their portfolio, but does so in a way where what's comfortable for Sixth Street. And we're trying to find those concentric circles. We have another one of my mentors, besides David Vineyards, Jamie Gates. Jamie Gates is, we call him the godfather at Sixth Street. He's one of the original founding partners of Sixth Street. And he taught me something early on. He said, just because you can raise the capital doesn't mean you should. And that was kind of an ethos that's been across Sixth Street. So we could like spray all our products on there, but or what we call strategies, but I think in the wealth, it's called products. But that's just not how we do things. So we've been on a listening tour, trying to figure out if there's sort of a concentric circle that works. But over time, I think there are ways to drive or offer something that it's a solution. And again, for us, the thing that we do is different than really, just because we've done it for so long, is that whole sort of relative value across a bunch of different asset classes. If we do something, it'll probably be somewhere in that investing philosophy. That's what we bet. But again, we're still in our listening tour.
Well, you start every investment with a blank piece of paper that you talked about. But how do you do that and scale? Meaning, how does your bespoke approach scale over time? And is it just adding people, or is it more than that?
We don't really think about it like that. Like we think about like, how do we drive outcomes for our clients? And if we can drive differentiated outcomes, that's what we try to do. So we're not thinking about deployment pace or how to, like, that's just not how we think. We think in terms of culture. We think in terms of our investment philosophy. And then the other thing, as we talked about, think in terms of capabilities. Because if we have the culture, we add a capability, that just makes us better, holistically better investors, because that adds another stool to overall algorithm of how we sort of go through our investment process. So that's kind of how we think about it. I mean, it's a very, everything we do is pretty artisanal. We're constantly turning things over and trying to, what we would say is like whiteboard. Like we're not like, oftentimes companies come to us, or, someone showing us a deal comes to us and they say, hey, here's what it is. And what we often say is, look, we'll show you that, but here's something else you might want to think about that's a win-win that we think is better. But if you want to do it, we'll do that. And we're probably generally not the best person on that other thing, because, there's 27 people that want to do that. But we try to use it. We call it right brain thinking. We try to use our right brains to try to come up with something different. And often what happens is when we come up with an idea that's a good idea, then we get on a whiteboard and we start mapping it out and try to really solve for a win for the CEO or the management team across the table. And that's what we do. And look, if there's one knock against us, it's, we're not a deployment factory and we're not solving for that. But again, it goes back to who you are. And for us, what we're all about is investing. It's what we love to do. It's in our ethos. And, but it's certainly not as scalable as a deployment factory.
What would you say is your overall economic and market outlook looking ahead?
We don't think about volatility. We think about the real economy. The real economy, like, it feels there will be some damage because there's definitely a slowdown in sort of consumer behavior, corporate boardroom behavior. Wasn't stoppage, but a real slowdown or thawing. And that did a little bit of damage, but I don't think it's major damage. Like ultimately, everything, particularly in the US, is about the consumer. Everything related to the consumer is about jobs. And again, there's some slight weakening, but in general, it feels, that feels pretty good. There's some risk on the horizon we can talk about, some of those risks and some of the early indicators we look at. But in general, that feels pretty good. From an investment environment perspective, and we're pretty constructive, there's a lot of things to like about the US. Obviously, you have to watch the bond market. The bond market's got a voice here. So obviously, that's something we're going to pay attention to. But there's a lot on a relative basis. The US is in a pretty good structural position, as long as there's not, there's a little bit of certainty sort of on the environment. The reality is, and I referenced this earlier, transaction volumes have been depressed for, really two-ish years. And there's a lot of just commerce or deal activity that's been waiting at the gates to happen that everyone thought was going to happen at the beginning of the year. It's delayed. That's all starting to happen. So in general, I think you have a pretty constructive outlook. There are definitely risks. The real economy feels pretty good because it's sort of really going back to the consumer and the job market. And as a result, now this commerce that we think is going to happen, or transaction activity, which we expect to really accelerate going into the second half of the year, like it feels pretty good. What are the risks? Risk number one, you got to obviously, looking at the bond market, you have to pay attention to the bond market, failed treasury auction in a very material way. Like there's some treasury scare moving assets, to non-dollar assets. That's obviously something we're watching. That again, we'll see how that evolves. The second thing is just, the whole AI. How's it AI as it starts to really sort of roll through sectors? How's that going to impact the job market? Obviously, everyone's sort of spoken about it theoretically, but you've had two parallel economies. You've had all the AI companies raising a lot of capital, hiring a lot of people. So you've almost had two different economies, an AI economy and a real economy, but you haven't starting to see the disruption. And I think you might be starting to see a little bit of it. And I think one thing to watch out is unemployment rates for undergraduates. Like that's started to tick up a little bit. That's like an early indicator. Unemployment rates for graduate students. So that's started to tick up a little bit. So those are little early indicator. Those are early indicators, but it's definitely a big watch out because when you think about these big transformations, I mean, the agrarian revolution, I think took place over 150 years of rebalancing the economy. The British Revolution took place over, I think, 70 or 80 years. The electrical revolution, call it 50 years. This is probably going to be less than that. It just takes a while for the economy to rebalance. And actually, the first AI person I've seen publicly speak out about it was actually today, the Anthropic CEO. I'd encourage you and everyone else to read it, of what we're watching. And just, again, there's risks, there's lots of opportunities, like bring down our deficit, healthcare costs. There's a lot of great things, but there's also risk. And again, it just needs time for the economy to rebalance. But I thought the Anthropic CEO did a pretty good job. It's in Axios. You can see it, but it's definitely worth your listeners reading just to sort of get into it. So put it all together, pretty constructive outlook. I think we're actually going to start to see real transaction volume, real M&A activity, real deal activity. And that's a good thing for our business. So, I mean, that's kind of how we see things, at least in the US.
I know you look at the macroeconomic outlook, obviously, but you also do significant bottom-up investing. How do you combine the two? And how do you weigh the importance of those two, particularly in an environment where you potentially have an unusually wide range of outcomes?
Our whole investment fund, this is why we didn't lose money in 01, 02 when everyone else made. This is why we didn't lose money in 2008, is because our whole view is that if you're just a bottoms up investor, you miss the macro. If you're just a macro investor, you miss the micro. So our whole thing is we want to be sensitive to the macro. We do have a macroeconomist at Sixth Street, but we all consider ourselves amateur macroeconomists because we want to be sensitive to it. But at the same time, you don't want to overwhelm it. We don't want to be macro traders because oftentimes for us, it's bottoms up. There's a lot of structuring, a lot of cases for our deals. So again, it's all, 90% bottoms up, 95% bottoms up. And I'd say sensitive to the macro. So you don't, that's where loss rates, you can have big loss rates if you don't understand that. And I think one of the challenges in private credit, I think there's, you can kind of see it in deals where risk pricing has changed, spreads go out, and there's a big credit event or big macro event, and like in the direct lending space, some people just keep pricing deals as if nothing's happened, and that's just not investing. And it's because they're not thinking about the world; they're just thinking about it in a very tunnel-like way. Again, this goes back to investment philosophy. If you look over loss rates over time, not the last 16 years, because the Fed's bailed out. Every time there's been a potential loss cycle, the Fed's bailed it out. But it's hard to do when you actually have inflation. It's hard to do when you have a balance sheet as big as the Fed's balance sheet. It's hard to do when QT hasn't worked the way that they thought it is. So I think when you look back and you study history, where people have gotten in trouble is like implicit versus explicit risk, but also just tunnel vision. And I think that's the problem with a lot of these strategy-specific sort of asset class. They're just looking at that and they don't see everything happening. And that's where it matters, and that's where loss rates come in. That's why our loss rates are so low for the last 27 plus years. And I think that's why we say we always want to be sensitive to macro, which is, that's kind of our investment philosophy embedded really from day one.
One of the flaws that I've observed is investors will look back and say, in 2008, that's like the worst case scenario. We would have been fine. And I think that's missing the fact of what you just described, which is, yes, that was a period where you had a big drawdown, but you had Fed policy, fiscal policy that had ample room to stimulate. And looking forward, it may be very different. Maybe the next downturn isn't as deep, but it may last a lot longer. And that has very different implications.
The challenge is there's been no loss rate experiences over the last 6 years because inflation's been low prior, obviously, till recently, and it's a real risk out there, and that's an embedded risk in this in the system. Is just a lot of participants in the market, they just haven't had seen cycles. And I'm not trying to do like the old guy, young guy thing, but it's a real thing. Watching what can happen, but a lot of times it happens is, and again, we saw it post, let's just say the volatility post Liberation Day, literally there were people still pricing deals the exact same way as if nothing had happened. And by the way, I saw that same thing in '08. And by the way, one of the reasons why we didn't lose money in '08, we didn't make any money, is because we saw people still doing that. And like, hey, you want to buy this? We'll sell you this. Because people get that tunnel vision and they don't sort of see the macro. They're just not set up that way. And that obviously gives an advantage to the larger firms like ourselves, but it's a real thing from an investment philosophy standpoint. It's, again, just look at the history. A lot of losses are made because, again, we have a saying at Sixth Street, everyone thinks their baby's the prettiest. Everyone thinks they're, if you just have an energy team, the energy team's always going to think that they grow up and they've just done energy their whole life. They're going to think energy's the best thing. It's always better than everyone else. And the healthcare, if that's all they've done. And that's why sort of the way we've always thought about it, and we learned a long time, you put all these people together, but you recognize there's things beyond the tunnel. And it's not just about what's in your baby, but it's really looking at, it's probably the bad metaphor, but it's looking across everything to sort of compare relative risk reward. But I mean, that's the syndrome. People get in the tunnel and they miss things. And again, when the Fed's bailing everything out, it's okay, but that's not investing. That I would say that's just hope. That's like a hope strategy that the Fed's going to continue to bail people out. Maybe they will, but again, that's not investing. It matters. It only matters when it does matter. And I think that's a lesson. I think, unfortunately, I think a lot of people are going to learn the hard way in the next cycle.
You briefly alluded to private credit. How would you say the private credit landscape has evolved since you started, and what improvements or risks do you see ahead?
It's evolved a lot. When we first started Sixth Street, the name private credit didn't exist. It just wasn't like when we started Sixth Street, we raised our funds, it didn't exist yet. It wasn't even a category. It started with opportunistic, and then ultimately opportunistic became sort of private credit. And now it's kind of its own category within a lot of the big allocators. So I think the first thing that's set up, it's one of the biggest changes is that, if you go back 16 years ago when we started, there's actually in almost every large pension fund or sovereign wealth fund, they have a private credit group. So that's a big change because now you've got sort of specified thing. The second change is everyone sort of thought private credit meant direct lending, even though we've always thought about, it's heterogeneous, like 30 different subcategories. And I think the industry is getting more sophisticated that there's like 30 different parts of private credit. It's not just direct lending. So I think that's sort of an evolution. And then the next evolution is like who the investors are. As you probably know, there's a lot of wealth capital coming into the private credit, more the direct lending space, and that's changing the market structure. Typically a lot of the private credit vehicles where you'd raise a drawdown fund, you invest it over 3 or 4 years, and with a lot of these evergreen vehicles, money comes in and you have to invest it. So just if you think about just as a manager, it's a different consideration versus you've got locked up capital, you have 3 or 4 years to invest it. So that whole sort of just change of mindset is starting to come into really the direct lending market, less so other parts of, I'm just going to use in quotes, the private credit market, more broadly defined. So I think those are the big areas. And the other thing I'd say is, look, when we started the direct lending business in 2000, there were like 3 of us. It wasn't called direct lending back then, it was called hybrid lending. And it went from 3 to about 18 in 2008. And in 2018, it went from 18 to about 5. And then it went from 5 to 1,000. So when you see that, just like you saw, again, it was a much smaller sample set, but when you think about from 2000 to 2008, you went from 3 to 18 to 5. We've gone from, I don't know, there's 5, I don't know what the number is, but a lot. When there's a cycle and there's losses and the skill of, how that ultimately sort of turns over and what ruptures that leaves in the private credit universe, I think there's going to be a lot more dispersion of outcomes for managers than what people have seen over the last 16 years, really going back to what you said, because there's just less tools available because of all sort of the structural, not big inflation, but just it's not going to go back to 0% interest rates. It's really hard to do that unless there's like a major recession. So those are some of the things that I think have evolved in the credit universe, but it's going to be interesting to watch over the next 5 years.
Well, Alan, I've learned a lot in our conversation, and one thing that I've learned is, to take a firm from 0 to 100 billion with, significant growth potential, even from there, I can see why your independent mindedness, having the grit of a college, soccer player that can play with a broken ankle and break through walls and survive, building culture and really putting investors first and keeping that culture even as you've scaled. I could see why you've had so much success. So I appreciate you sharing all those insights with us today.
Thank you for having me. I enjoyed it, and look forward to seeing you soon. Thanks, Alex.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.